welcome back to the Deep Dive. Have you ever found yourself sifting through a company's financial report, maybe for an investment or a new job, or
Yeah.
even just, pure curiosity, and maybe a tiny voice in your head whispers, can I really trust these numbers?
Mm-hmm.
Well, you are in for an absolute treat today
Yep.
because we are taking a fascinating shortcut to becoming incredibly well-informed about just that.
Indeed. Today, we're pulling back the curtain on one of the most critical, yet I think often misunderstood processes in the financial world,
Right.
the audit engagement. It's so much more than just a routine check of boxes.
Right.
It's really about providing the very bedrock of trust in our economic system.
Absolutely. Our mission today is to truly demystify this pretty intricate process. We're going to unpack who does what, explore the subtle art of professional judgment, and uncover why this entire exercise is absolutely essential for anyone, really, who interacts with financial information.
Mm-hmm.
We've taken a deep dive into our sources on audit engagements, and we're ready to hand you the key insights. Let's get started.
Okay, let's unpack this. Before we get into the nitty-gritty of how audits actually happen, maybe let's zoom out for a moment.
Good idea.
Why do we even have financial audits in the first place? What's the fundamental sort of overarching purpose of this whole exercise?
That's the perfect place to begin, really. The fundamental purpose of a financial audit is to provide financial statement users.
Okay, users being like investors, creditors.
Exactly. Think investors, creditors, potential business partners, even employees sometimes,
Mm-hmm.
providing them with an independent opinion.
An independent opinion.
Right.
And this opinion, it basically states whether the financial statements are presented fairly, and that's in all material respects.
Material respects, okay.
And crucially, in accordance with the applicable financial reporting framework, this isn't just, technical jargon, it's the very foundation of financial credibility.
And when you say applicable financial reporting framework, what exactly are we talking about there? Because that sounds pretty important for, consistency.
It is vitally important. The applicable financial reporting framework is essentially the specific rule book, right?
Yeah.
It's the established set of principles or standards that a company uses to prepare its financial statements.
Okay. Like a blueprint.
Exactly like a blueprint.
Yeah.
Or maybe building codes for a house. It ensures it's safe, structurally sound.
Hmm.
Well, the financial reporting framework is that blueprint and code for financial statements. It dictates, everything from how assets are valued to how revenue gets recognized.
Oh, okay.
It just ensures a consistent approach. And the choice of framework, it depends on several factors, like the nature of the entity, its legal structure, its operating environment.
Makes sense.
So, for example, here in the United States, privately held companies often use U.S. Generally Accepted Accounting Principles, or GAAP.
Right, Gap. Heard of that.
Yeah, they're a pretty comprehensive set of rules from the Financial Accounting Standards Board, FASB. But then globally, many companies follow International Financial Reporting Standards, IFRS.
IFRS, right.
Yeah, those are developed by the International Accounting Standards Board, used in, I think, over 140 countries now.
Wow.
And then you also have these things called special purpose frameworks.
Special purpose.
Yeah, for entities with very specific reporting needs. Think like a cash basis framework for a small nonprofit, something like that.
Gotcha.
So the existence of these frameworks, and importantly, the auditor's confirmation that they've actually been followed, that's incredibly important because it ensures consistency and comparability.
Right, so you can compare apples to apples, basically.
Precisely. Without a standard set of rules, every company could just, invent its own way of presenting financial information.
Chaos.
Total chaos. Trying to compare one company to another, or even just track one company's performance year over year, would become nearly impossible. So the auditor's opinion essentially confirms that the company played by the agreed-upon, established rules in preparing its statements. It gives everyone a common language, a common baseline for evaluation.
So if I'm understanding this correctly, the ultimate insight here is that an audit isn't just some regulatory hurdle they have to jump through.
No, not at all.
It's more like the market's mechanism for translating a company's own story, their self-reported story, into a narrative that people can actually trust more widely. It's what lets different investors and creditors sort of speak a common financial language and make informed decisions. Is that a fair way to put it?
That's a very powerful distillation of it, yes. The auditor's report is what gives those financial statements their credibility. I mean, think about it. If a company just publishes its own financial results without any external verification,
Right.
no matter how honest its management tries to be, there's an inherent bias, isn't there?
Sure, they want to look good.
Exactly. They're naturally motivated to present their performance in the best possible light. They're reporting on their own activities, so there's an immediate question of objectivity. Without a report from an independent auditor, a third party, who's truly separate from management, providing that objective, unbiased view, a company's financial statements would largely be, well, almost meaningless to the public. People would just have a little faith in numbers coming from such a biased source.
Makes sense.
So the auditor steps in to provide that objective, unbiased view. And that independent verification is what provides the trust necessary for capital markets to function efficiently.
Oh, okay.
It lets capital flow to productive enterprises because investors and lenders can reasonably rely on the reported financial health.
You know, something I've always personally struggled to grasp, and I bet many of our listeners do too, are the auditors actually the ones who prepare the company's financial statements? Can you clear that up for us? Because it feels like they're so involved.
This raises a very common and really important misconception, and it's absolutely crucial to get the distinction right. The financial statements of an enterprise are prepared by the management of that enterprise.
Okay. Management, not the auditors.
Not the auditors. The financial statements are the product and property of the enterprise itself. The independent auditor merely audits them and then expresses an opinion on them.
Okay, so like an inspection rather than creation.
Precisely. Think of it like this. Imagine you're building a car.
Okay.
The engineering team designs it, the manufacturing team builds it, quality control checks it. They prepare the car.
Right.
An independent mechanic then inspects that finished car and gives an opinion on its safety, its roadworthiness, maybe compliance with standards. The mechanic doesn't build the car, they just provide an objective assessment of the car that was built.
That's a great analogy.
It's the same idea. Company management is responsible for all the complex processes, the decisions, the accounting entries that, culminate in those financial statements. The auditor's role is purely to examine those statements and the underlying evidence, not to create them. And this distinction, it's absolutely fundamental because it sets the stage for understanding the different responsibilities of management versus the auditor.
Okay.
It's key to appreciating the whole nature of the audit relationship.
That distinction makes perfect sense and really highlights the different roles. So management truly owns the books.
They do.
And is there integrity in preparing them and, importantly, providing access that sets the stage for everything else? Given that immense responsibility on management side, what then is the auditor's equally crucial, non-negotiable role in this complex dance?
You're right. Management's role is absolutely foundational. An audit is conducted on the premise that management and, when appropriate, those charged with governance, like the board of directors or the audit committee.
A lot of oversight, folks.
Exactly. The oversight folks, they are primarily responsible for three fundamental areas. First, they are responsible for the preparation and fair presentation of the financial statements in accordance with that applicable financial reporting framework we just discussed.
Okay, prep and presentation.
And this is an enormous undertaking. It involves correctly identifying which framework to use, meticulously applying it to all the company's transactions and events, and then, crucially, including an adequate description of that framework right within the financial statements themselves.
They have to spell it out.
They do. It's their job to get the numbers right, present them clearly, and make sure they conform to all the established rules. They can't just outsource this to the auditor. It's their core duty.
Okay, that's number one.
Second, management is responsible for the design, implementation, and maintenance of internal control.
Internal controls. The guardrails.
Exactly, the guardrails and safety mechanisms within the company. These are the systems, policies, procedures a company puts in place to safeguard assets, ensure accuracy and reliability of financial records, promote operational efficiency.
Like needing 2 signatures on big checks.
That's a classic example. Or secure IT systems, clear segregation of duties so one person doesn't control a whole transaction from start to finish. Management has to not only design these guardrails effectively, but also make sure they're actively working and being maintained over time. The goal is to prevent or detect errors and fraud before they become significant problems in the financials.
Okay, makes sense. Design, implement, maintain controls. What's a third?
Third, management is responsible for providing the auditor with access.
Access to everything.
Pretty much. Access to all necessary information and persons within the entity needed to complete the audit. This means transparency is absolutely paramount. The auditor needs to see all relevant records, documents, other information, contracts, bank statements, invoices, ledgers, you name it. And they also need to be able to talk freely and openly with employees at all levels, managers, anyone who can provide insights or evidence relevant to the audit.
No hiding the ball.
Exactly. If management restricts or limits access in any way, the auditor just cannot obtain the necessary evidence to form an opinion. They can't complete their work. So these three responsibilities really highlight that management owns the financial statements, the processes behind them, and the environment of cooperation for the audit.
That's a crystal clear breakdown of management side. They own the numbers, they build the systems, they open the books. So with that foundation laid, what about the auditors? What are their specific non-negotiable responsibilities beyond just giving that all-important opinion?
Right. Beyond expressing that crucial opinion, auditors have 5 critical responsibilities that guide their entire process. These are meticulously outlined in Generally Accepted Auditing Standards, or GAS.
Yes.
Yeah, and these aren't just suggestions. They are the core principles, the professional duties that dictate how an audit must be conducted to be legitimate and trustworthy. First, the auditor must constantly be maintaining professional skepticism.
Skepticism, we talked about that a bit.
We did, and it's key. It's not just being generally suspicious. It's a specific, active attitude, questioning mind, critical assessment of all audit evidence, not taking anything at face value.
Got it. Active skepticism.
Second, they must strictly be complying with relevant ethical requirements.
Ethics, like independence.
Exactly. And within ethics, independence is absolutely paramount. Both independence, in fact, actually being objective, and independence in appearance looking objective to outsiders. Vital for credibility.
Okay. Ethics and independence.
Third, auditors are responsible for exercising professional judgment throughout every stage. Planning, performing the audit.
Judgment, not just following a checklist.
Precisely. Making informed, reasoned decisions based on their training, knowledge, experience, not mechanical.
Okay. Judgment. What's fourth?
Fourth, they must diligently be obtaining sufficient appropriate audit evidence.
The proof.
Yes, the proof. This is the bedrock their opinion rests on. Gathering enough reliable and relevant information, documentation to support every conclusion. No guessing, no assuming. Solid, verifiable evidence.
Sufficient appropriate evidence.
Got it.
And fifth.
And fifth, critically, auditors must be complying with generally accepted auditing standards. GAAS.
Back to GAS.
Yes. These are the established rules, the frameworks, the guidelines for conducting an audit issued by bodies like the AICPA in the U.S. If an auditor says their audit was done according to GS, they are legally and professionally bound to have followed all the relevant requirements in those standards.
Okay.
So those 5, skepticism, ethics, judgment, evidence, and GAS compliance, they collectively define the auditor's professional duty and frame every single step of the audit.
Let's really dig into professional skepticism then, because like you said, it's vital and I think often misunderstood outside the profession. It sounds a bit like being a financial detective, always questioning everything. What exactly does that mean an auditor needs to do, like day to day, to embody this?
Yeah, what's fascinating here is that professional skepticism isn't a passive trait. It's an active, ingrained attitude.
Yep.
The auditor must apply it when making professional judgments. It's a constant, vigilant state of mind, necessary for the critical assessment of all audit evidence from a simple invoice to a complex financial model. It means maintaining that questioning mind and being inherently alert to certain, let's say, red flags or inconsistencies that might indicate a problem.
Like what kind of red flags?
Well, specifically, auditors should always be alert for several things. First, audit evidence that contradicts other evidence they've already obtained.
Contradictions, okay.
Yeah. For instance, if sales records show a huge spike in revenue right at year end, but inventory levels don't show a corresponding decrease in goods sold.
That doesn't add up.
Right. That's a contradiction that immediately demands further, deeper investigation. Second, information that calls into question the reliability of documents or responses to inquiries.
Reliability. Like if something looks fishy.
Exactly. Not outright suspicion necessarily, but a critical eye. If a document looks altered, maybe, or an explanation from management seems evasive or overly simplified, that raises a legitimate question about its reliability. They also look at the controls over how that info was prepared. Weak controls mean less reliable documents.
Got it.
Third, conditions that might indicate possible fraud.
Okay, looking for fraud indicators.
Yes, but importantly, it doesn't mean starting by assuming fraud is present. It means being acutely sensitive to circumstances where it could occur. Things like unusual transactions, maybe a lack of proper segregation of duties, or management pay being heavily tied to aggressive financial targets.
Right. Incentives matter.
They do. Fourth, circumstances that suggest the need for additional audit procedures beyond the standard requirements. So, adapting the plan, yes. If an initial review points to an unusual or elevated risk, they shouldn't just stick to their pre-planned steps. They need to adapt, expand procedures, dig deeper.
Okay.
And finally, they should be alert for audit evidence that might change the auditor's initial identification and assessment of the risks of material misstatement.
So risk assessment isn't static.
Not at all. An audit usually starts with a robust risk assessment, but newer information might emerge during the audit that changes how risky certain accounts or processes seem. That requires a reevaluation of the whole audit plan, maybe leading to more extensive testing. It's this ongoing, dynamic process of questioning and critical evaluation, where assumptions are always challenged.
So it's definitely not about assuming everyone is dishonest,
No.
but it's equally not about blindly trusting either, right? That sounds like a really difficult balance to strike.
Precisely. And this core principle, often called a passkey in the field.
A pass?
Yeah, meaning a fundamental concept you absolutely must grasp to unlock a deeper understanding.
Okay.
The passkey here is critical. The auditor should neither assume that management is dishonest nor assume unquestioned honesty.
Neither assume dishonesty nor assume unquestioned honesty.
Okay. It's a fine but incredibly important line to walk. Believing management is honest and has integrity doesn't relieve the auditor of the need for skepticism. It doesn't allow them to be satisfied with less than persuasive evidence.
Right. Trust but verify, basically.
Kind of, but even stronger. Auditors aren't forensic investigators starting with the premise of fraud. They're not law enforcement. But they also can't just take management's word for everything. If management says an account balance is correct, the auditor still needs independent corroborating evidence to verify it. Even with a long-standing positive relationship, that professional trust must never override the requirement for objective, verifiable evidence. It's about having that questioning mind, critically evaluating everything presented, seeking corroboration for management's assertions, regardless of how honest you think they are. Ultimately, it's about the evidence. Let the evidence guide the conclusions.
Okay. That makes it sound like an auditor should be this sort of superhuman, perfectly objective truth seeker. Which sounds ideal, but if it's so important and foundational, why would auditors ever struggle with it? What are the real-world things that get in the way of consistently applying professional skepticism? It sounds like a massive daily challenge.
It really is. And this raises a profoundly important question. It's where the human element of auditing truly comes into play. Auditors do often feel challenged to meet this requirement consistently, and that's because of various impediments, many of them deeply human and systemic within the profession itself.
Okay, like what?
Well, one major impediment is unconscious human bias.
Bias. We all have it.
Exactly. Auditors, like all people, are susceptible to a range of cognitive biases. These can subtly cause them to favor information that supports the client's interests over, say, investors' interests, or maybe prefer evidence that corroborates their existing beliefs rather than evidence that contradicts them.
Confirmation bias.
Right. We look for what we expect to find.
Precisely. And this isn't usually intentional malice or a desire to mislead. It's often an unconscious inclination. And this inherent human bias can be, let's say, facilitated or amplified by several strong incentives and pressures that are just part of the audit environment.
Pressures like what?
Well, for example, there's a natural desire to maintain and build strong long-term client relationships. Audit firms are businesses, after all. Happy clients mean repeat business.
Sure, the business side.
Then there's a subtle but powerful pressure to provide an unmodified, often called an unqualified or clean audit opinion. That's generally what clients want. It signals financial health.
Right, a clean bill of health. Exactly. Plus, there's pressure from within the audit firm to keep audit costs low. That might tempt auditors towards shortcuts, maybe accepting less persuasive evidence just to save time.
Efficiency pressure.
And, critically, the firm's desire to cross-sell other services to the client like tax advice or consulting can create a subtle, unconscious pressure to not rock the boat with a tough audit finding that could jeopardize those other lucrative engagements.
The cross-selling conflict.
It can be. All these factors, often unstated, can subtly influence an auditor's judgment, maybe even without them fully realizing it.
Okay, so unconscious bias, plus those business pressures. What else?
Another impediment is developing an inappropriate level of trust or familiarity with management.
Getting too close.
Kind of. When auditors work with a client for many years, they naturally become familiar with management, often developing a good professional rapport. And while a good working relationship helps efficiency, too much familiarity can lead the auditor to not take a sufficiently questioning stance. They might unconsciously become less rigorous because they know and trust these individuals. It can blur the lines.
Right.
Then there's the very human pressure to avoid potential negative interactions or consequences.
Avoiding conflict.
Yeah, nobody really likes conflict. If a critical audit finding means delivering difficult news, maybe confronting a CEO or CFO they've worked with for years, there can be an inherent human desire to avoid that uncomfortable situation, and that could potentially compromise their objective representation of, say, investor interests.
That makes sense. It's awkward.
It can be. And finally, there are significant practical constraints like scheduling and workload demands.
The busy season crunch.
Exactly. This is a huge, often unspoken challenge. Intense deadlines, heavy workloads, the constant push for efficiency, it can lead to shortcuts in judgment. For example, an auditor under time pressure might seek evidence that's easier to get rather than evidence that's more reliable and relevant just because of the clock.
Cutting corners unintentionally.
Or they might give more weight to evidence supporting management without adequately considering contradictory evidence, just to move things along and hit a deadline. These relentless pressures make the consistent, thorough application of professional skepticism a constant uphill battle. It takes immense discipline and a really strong ethical compass.
Wow, that's a lot of pressure and intricate human factors at play. It really does highlight the daily ethical tightrope walk an auditor faces, balancing that professional duty with all these real-world constraints. That makes perfect sense. And that brings us perfectly to another cornerstone of the audit profession, the ethical requirements themselves. Beyond skepticism, what are those core ethical mandates for an auditor?
That's an excellent segue, yeah. Ethics are truly the bedrock upon which the entire audit profession stands. The auditor must comply with ethical requirements related to financial statement audit engagements. And the most crucial of these is independence.
Independence again, both in fact and appearance.
Exactly. Independence, in fact, means the auditor truly maintains an objective and unbiased mental attitude throughout the audit. They're not influenced by personal relationships, financial interests, other pressures. It's about their actual mindset.
Okay.
Independence in appearance, on the other hand, means that objective third parties looking at the situation from the outside would conclude the auditor is independent.
How it looks to others.
Precisely. Avoiding situations where an informed observer might reasonably question their objectivity. For instance, an auditor can't own stock in a client company.
Right.
Or have close family members in key management jobs at the client. Because even if they feel objective, the public might question it. And this independence includes adhering to comprehensive codes of conduct, like the AICPA Code of Professional Conduct.
The rule book for CPAs.
Basically, yes. It sets out broad principles and specific rules CPAs must follow regarding integrity, objectivity, due care. Plus, auditors often have to comply with even more restrictive rules from state boards of accountancy, regulatory agencies, depending on the client and jurisdiction.
Like for public companies.
Especially for public companies in the U.S. They fall under the Public Company Accounting Oversight Board, the PCAOB.
PCAOB, okay.
And they have their own very strict independence rules prohibiting certain non-audit services or financial relationships to ensure the auditor's impartiality. And here's another crucial passkey.
Another one, okay.
Yes. The auditor must be independent of an entity when performing an engagement under GA. That's the fundamental rule. There are only very narrow exceptions, like GAIS might explicitly allow something else for a very specific limited type of engagement, which is rare for a general audit. Or the auditor might be legally required by law or regulation to accept the engagement and report, even if certain independence threats can't be fully eliminated.
Really? Even if not fully independent?
Very rare cases. And even then, they'd have to disclose the lack of independence and explain the precise circumstances to everyone using the statements. This legal nuance just emphasizes how absolutely fundamental independence is to the integrity of the whole audit process and the trust people place in the opinions.
Right.
Without it, the entire system of financial reporting credibility would essentially just fall apart.
And then there's professional judgment. That phrase, it sounds a bit like using your gut instinct, but I'm guessing it's far more structured and rigorous than that.
Oh, absolutely. Much more than a gut feeling. Professional judgment is the disciplined application of relevant training, knowledge, and accumulated experience, all within the context of auditing standards and ethical requirements, to make informed and reasoned decisions throughout the audit process.
Disciplined application.
Okay, yes. And it's absolutely necessary because an audit isn't a rigid checklist you can just tick off. Every audit has unique challenges. It requires constant interpretation of ethical rules, of GAS, plus informed decisions based on experience in countless unique situations. Auditors aren't just looking for black and white answers. Often they're navigating complex shades of gray, where accounting rules require estimates, assumptions, subjective assessments from management.
Like guessing the useful life of a machine.
Exactly. Or the probability of collecting a difficult receivable. Those require judgment from management, and the auditor needs judgment to evaluate that judgment.
So where does this professional judgment come into play specifically?
Oh, constantly, every single day. For example, they apply it when making decisions about determining materiality.
Right, how big an error has to be to matter.
Exactly. And there isn't a fixed universal percentage or dollar amount. It requires nuanced judgment based on the company's size, industry, the nature of the misstatement, specific circumstances. Like a $10,000 error might be immaterial for a huge tech giant, but absolutely critical or material for a small nonprofit.
Context matters.
Hugely. The auditor has to consider not just the dollars, but the nature of the item and its potential impact on a user's decision. They also use judgment in assessing audit risk.
The chance of missing something important.
Sort of. It's the likelihood the financials contain a material misstatement before the audit starts, and also the risk the auditor won't detect it. This isn't just a calculation, it's a qualitative assessment that drives the whole audit plan, influencing where they focus their efforts.
Okay, what else?
Deciding the nature, extent, and timing of audit procedures.
What to test, how much, and when.
Precisely. What specific procedures? Inspect documents. Observe inventory counts. How much evidence? Sample 50 invoices or 500. Extend the test period. When? At year end. Throughout the year. All these critical decisions are based on their professional judgment of risk and materiality tailored to that specific client.
Makes sense.
Also, evaluating whether sufficient, appropriate evidence has been obtained. They constantly judge if they have enough reliable, relevant evidence to support their conclusions. It's a continuous weighing process.
Okay.
And crucially, evaluating management's judgments in applying the financial reporting framework.
Oh,
like
sure.
those estimates we talked about. Auditors must critically challenge and evaluate the reasonableness of those management decisions, not just accept them.
Challenging management's judgment. Okay.
And finally, drawing conclusions based on the audit evidence obtained. The final audit opinion itself is the direct result of applying their professional judgment to all the evidence gathered.
Right.
So it's this critical blend of rules, ethics, and seasoned expertise. It lets auditors apply abstract principles to specific, often unique situations, not just mindlessly following a rote process. It demands constant critical thinking, deep understanding of accounting and business.
That brings up a fascinating point. If it requires all this judgment and skepticism, what level of certainty does an audit actually provide? We keep hearing this term reasonable assurance. Is it 100% foolproof or something else entirely?
Ah, yes. This raises a profoundly important question, and it's a key concept for anyone using audited financial statements. To express an opinion, the auditor obtains reasonable assurance that the financial statements are free from material misstatement, whether due to error or fraud.
Reasonable assurance.
And what's fascinating here is that reasonable assurance is precisely defined as a high but not absolute level of assurance.
High but not absolute. Okay, that's a key distinction.
Absolutely crucial for users to understand. It means the auditor is highly confident in their opinion, but they are not guaranteeing perfection. They're not saying every single number is accurate down to the last penny, or that no tiny error or obscure fraud could possibly exist.
So how do they get to that high level?
Through a systematic, comprehensive, and rigorous process. First, meticulously planning the work and properly supervising any impostance. Good planning directs effort efficiently to critical areas.
Okay, planning and supervision.
Second, diligently determining and applying appropriate materiality levels. Focusing on misstatements big enough to potentially influence users' decisions, not getting lost in tiny details.
Focusing on what matters.
Third, proactively identifying and assessing risks of material misstatement, whether from error or fraud. This deep understanding of risk guides the whole approach.
Assessing the risks up front.
And finally, obtaining sufficient appropriate audit evidence, enough evidence that's both relevant and reliable, to reduce audit risk down to an acceptably low level. This robust evidence then lets them draw reasonable conclusions for their opinion.
Okay.
So, while it's not a guarantee against every conceivable anomaly, it's a very robust, structured process designed to provide a very high degree of confidence.
So if it's a high level of assurance, but explicitly not absolute, what are the inherent limitations? What can't an audit guarantee, no matter how diligently it's performed? This feels really critical for users so they don't have unrealistic expectations.
You're absolutely right. Understanding the inherent limitations is crucial. These are fundamental factors that prevent an auditor from getting absolute assurance. They define the realistic scope. The first major limitation stems from the nature of financial reporting itself.
The accounting rules themselves.
Not just the rules, but their application. Many financial statement items are inherently subject to variability because they involve significant judgment by management, subjective decisions, or a degree of uncertainty.
Like those estimates again.
Exactly. Complex accounting estimates like valuation allowances for bad debts a company might never collect, or provisions for future warranty claims, or the fair value of complex financial instruments. These aren't precise, easily verifiable numbers. They involve management judgment, assumptions about the future.
Right.
The auditor's role is to evaluate the reasonableness of that judgment, not to replace it with a perfectly precise figure or guarantee the future.
Okay, limitations from the nature of reporting. What else?
The second limitation arises from the nature of audit procedures themselves.
How they actually do the audit.
Yes, there are practical and legal limits on an auditor's ability to obtain all possible audit evidence. For instance, there's always the possibility management or others might not provide complete information.
Intentionally or unintentionally.
Could be either intentional concealment or just an unintentional oversight. Furthermore, fraud, especially if it's well orchestrated, may be involving collusion.
Like multiple people working together.
Right. It can be concealed so sophisticatedly that it's exceedingly difficult to detect with standard audit procedures, even diligent ones. And it's vital to remember, an audit is not an investigation into wrongdoing designed to uncover every single fraud.
Okay.
Nor does the auditor have specific legal powers, like subpoena power, that law enforcement has. Their role is reasonable assurance on the financials, not uncovering every possible fraud.
Got it. Nature of reporting, nature of procedures. Is there a third?
Yes. The third major limitation relates to the timeliness of financial reporting and the necessary balance between cost and benefit.
Deadlines and budgets, basically.
Essentially, yes. Users, especially investors in public companies, expect and need timely financial information to make decisions. So auditors have to form an opinion within a reasonable period. And there's an inherent practical balance between the benefit of the audit, the assurance, and its cost.
Can't check absolutely everything.
Exactly. It's simply impractical, economically unfeasible to address every single piece of information or examine every transaction in a large, complex organization. So, pragmatically, auditors must plan the audit effectively and efficiently, use resources wisely, focus on high-risk areas,
Okay.
direct efforts to areas most likely to contain risks of material misstatement, focus where errors or fraud are most likely based on their understanding,
Prioritize.
and use testing and other sampling means. Select a representative sample to examine rather than every single item.
Sampling isn't foolproof, though, right?
It's scientifically valid and necessary for efficiency, but yes, it inherently means they don't look at everything. There's always a small theoretical risk a material misstatement could exist in the unexamined part. So these fundamental limitations mean an audit provides high assurance, but it's not a guarantee. It's a pragmatic, highly valuable approach within the real constraints of business.
That really clarifies the realistic scope and expectations. Super helpful. So, given these complexities and the varying needs of different businesses, what different types of audit engagements actually exist? It feels like it wouldn't be a one-size-fits-all situation.
You're spot on. Definitely not one size fits all. What's fascinating here is how the scope and nature of an audit can vary significantly. It's tailored to the entity's needs and what users require. An auditor might be hired for, say, a single financial period, just the last fiscal year, common for smaller private companies seeking financing,
Okay, 1 year.
or for multiple periods, maybe the last 3 to 5 years consecutively, gives a trend often seen in M&A deals.
Multiple years. Got it.
And the audit might cover the complete set of financial statements, balance sheet, income statement, cash flows, equity statement, all the notes. That's the most comprehensive.
The full package.
Or sometimes a client only needs an audit of a single financial statement, like just the balance sheet for a specific loan covenant, perhaps.
Just one piece.
And even more specific, an audit can be limited to specific elements, accounts, or items within a statement, like just accounts receivable or revenue for one division. called specified elements audits.
Very specific.
Yeah. And it's also worth noting, many audit firms get hired for other professional services too, besides the audit.
Like taxes.
Exactly. Tax services are common, preparing returns, complex planning advice, or even certain consulting services, maybe advising on IT systems or internal control improvements.
Okay.
But, and this is critical, the firm must rigorously manage potential conflicts of interest and ensure those non-audit services don't impair their independence for the audit. Highly regulated, especially for public companies.
Right. Independence again. And I remember hearing about issuers versus non-issuers.
Yeah.
How does that distinction affect the type of audit they get, especially around internal controls?
Yes. This is a crucial distinction, particularly for the audit of internal controls, which is a major focus for investor protection. Issuers and non-issuers primarily refers to whether a company's securities, stocks, bonds are publicly traded on exchanges.
Public versus private, basically.
Largely, yes. Non-issuers are typically private companies. Their equity or debt isn't traded publicly. For these entities, the auditor first figures out if an audit is even the right thing. Maybe a review or compilation, which give lower assurance, is more suitable.
Oh.
If an audit is needed, non-issuers have a choice about the scope. They can opt for a financial statement audit only.
Just the numbers.
Right. One opinion solely on the fairness of the financial statements. Common for private companies getting bank loans. Alternatively, a non-issuer can choose an integrated audit, more comprehensive.
Integrated meaning.
Meaning two opinions are rendered, one on the fairness of the financial statements and a separate one on the operating effectiveness of their internal controls over financial reporting.
Controls too. Why would a private company choose that?
Maybe they're planning an IPO down the road and want robust controls. Or a private equity investor might require it for due diligence, wanting assurance on the systems, not just the numbers.
Okay, so non-issuers have a choice. What about issuers?
Issuers. These are typically the publicly traded companies. Securities registered with a regulator like the SEC here in the U.S. Think Apple, Microsoft, maybe your local utility if it's public.
Got it. Big public companies.
For these entities, when auditing issuers, the auditor must perform an integrated audit.
Must. Not optional.
Not optional. An integrated audit of the client's financial statements and their internal controls over financial reporting. It's a mandatory requirement imposed by regulators like the PCAOB, stemming directly from laws like Sarbanes-Oxley back in 2002.
Oh, it's SOX. Then.
Exactly. Passed after those big accounting scandals to improve corporate governance and reporting. So, for public companies, the audit of internal controls is fundamental, legally required. Ensures investors have confidence not just in the final numbers, but also the underlying processes that generated them.
That really clarifies the distinction, especially the mandatory part for public companies.
Yeah.
Okay, let's connect this to the bigger picture then. What are the overall objectives for these different types of audit engagements? Each sounds like it has a slightly different mission or ultimate goal.
You're absolutely right. They do have distinct overall objectives, even under the broad audit umbrella. Each serves a specific purpose. First, the objectives of the financial statement audit, general. Most common type. Applies to issuers, non-issuers, governmental entities. Core objectives are twofold. First, obtain reasonable assurance.
High, but not absolute.
Exactly. That the financial statements as a whole are free from material misstatement, whether from error or fraud. This lets the auditor express an opinion on whether they're presented fairly in all material respects, following the framework, GAAP, IFRS, etc.
Okay, assurance and opinion on the numbers.
Second objective is to formally report on the statements, issue the written audit report, and communicate any other required findings mandated by GIs based on their work.
Yeah.
So, independent, reliable assurance on the financials themselves.
Got it. What about the internal control audit?
Right, the objectives of the audit of internal control over financial reporting. Mandatory for issuers, optional for others. Objectives here are specific to the internal control environment. First, express an opinion on the effectiveness of the company's internal control over financial reporting as of a specific date.
An opinion on the controls themselves.
Yes, distinct from the financials. It's an opinion on the underlying systems and processes meant to ensure data integrity. Second, to do this, the auditor must plan and perform the audit to get enough appropriate evidence to have reasonable assurance about whether material weaknesses exist in those controls.
Material weaknesses.
Yeah.
Big problems in the controls.
Essentially, yes. A deficiency in internal control that could lead to a material misstatement in the financials not being prevented or detected. And remember, this audit must be integrated with the financial statement audit. The work on controls informs the work on the financials, and vice versa. Weak controls mean more testing on the numbers.
Integrated. Okay. And the third type, ERISA.
Yes, highly specialized audits, like the objectives of the ERISA Plan financial statements audit.
For retirement plans like 401ks.
Exactly. ERISA is the Employee Retirement Income Security Act, sets minimum standards for most private industry retirement and health plans. The objectives here are tailored to these plans and their specific regulations. Includes things like, first, accepting the engagement only when specific preconditions are met, like management understanding its responsibilities for the plan's financials.
Okay.
Second, ensuring the audit is properly planned and performed, including specific procedures for certified investment info if management elects a limited scope audit allowed under ERISA Section 103A3C.
Specific plan rules.
Yes. Third, forming an opinion on the ERISA plan financials based on evidence and expressing it clearly in a written report. Fourth, performing extra procedures and reporting on supplementary information required for these plans. And finally, communicating any reportable findings to management and those governing the plan, like the administrator or trustee. So each type serves a crucial, distinct purpose, but all contribute to transparency and trust in financial information, whether for a huge corporation or a retirement plan.
Okay, that ties it all together beautifully. We've seen the why, the who, the how, the realistic limitations, and now the various forms these audit engagements can take. It's truly a comprehensive picture. So what does all of this mean for you, our listener, the person actually using these financial statements? We've seen that an audit isn't just a simple stamp of approval, right?
Not at all.
It's a complex, highly regulated process built on deep professional judgment and a healthy, active dose of professional skepticism. All this intricate work is designed to provide that crucial layer of trust in financial reporting, making the numbers more reliable for everyone, from individual investors to large institutions.
And if we connect this back to the bigger picture, given those inherent limitations of an audit we discussed, and especially the human biases, the practical pressures that can challenge even the most diligent professional skepticism, what does this imply for your role as a user of financial statements? How might understanding these challenges change how you interpret the credibility an audit provides? And perhaps what deeper, more discerning questions might you now ask about the financial information you encounter, moving beyond just seeing a clean opinion?
That's a powerful thought to mull over. It's not just about what the auditor says in their report, but also about understanding what they can and cannot say, and crucially, why those limitations exist. It really transforms you from just a passive receiver of information into a more critical, informed consumer. Thanks so much for joining us for this deep dive into audit engagements. We really hope you feel much more informed and ready to approach financial statements with some newfound insight. Until next time.